Today, we are looking at passive investing and how that machine has forced stock markets up to historic high valuations. However, that strong positive force behind stocks could be turning towards the negative, and it's going to force valuations down around 30%. Before we get too deep into the video, I want to do my update to the growth on sale portfolio. It's a brand new week, which means another $300 has been added, and I've bought the company PG&E, a utility company based mainly in California. The company should see earnings per share growth increase 8% moving forward, and it's only at valuation in the single digits. Make sure you subscribe to the channel to keep updated about the portfolio and see the results directly of the things we discuss here all together. But getting on with the main topic of the video, let's begin by defining what exactly is passive investing. Now, most people in the market, around 60%, do passive investing. That just means they just put their money into the entire stock market. The most popular way of doing this is buying the SPY, which is the ETF version of the S&P 500, or the biggest 500 public companies in America. There is strong evidence to suggest that buying the entire economy, buying all of the public companies in the stock market, gives you better performance than if you went out and did research and only bought a handful of different companies. There is a famous bet made by Warren Buffett versus active managers on Wall Street, where Warren Buffett just said, look, over this period of time, I'm just going to put money in the S&P 500, and I bet you I will win against your active portfolio. Warren Buffett won that bet many times during the 2010s time period. There was an average of 35.6% of portfolio managers that managed to beat passive investing, beat the S&P 500. That was measured over a 22-year time period from 2001 through to 2023. And during that time, only 3 years did professional money managers on average beat the S&P 500. Therefore, the most popular advice from professional money managers, you pay people hundreds, thousands of dollars to give you advice, and their feedback is to just buy the entire market, buy the S&P 500. That idea has been coined passive investing. And because so many people follow that logic and follow that advice, we've actually forced the entire financial system to adapt. We have now eliminated something called price discovery. So normally, if you allow people to research and pick companies one by one, what you would naturally see is better companies get higher valuations and worse companies slowly see their value decrease. We measure the value of public companies mainly through something called a PE ratio. I'm sure everyone knows what that is, but in today's day and age, it doesn't really matter how good your company is often at making profit. The bigger, more popular companies receive more of these passive flows and hence get higher valuations. We can see this in many different graphs, but the most popular one is comparing the S&P 500, the top 500 companies. That PE ratio on a 12-month forward basis is around a 22. However, if we actually look at smaller companies in what are called the S&P 400 and 600, so those would be companies between 501 biggest to the 1500th biggest company in America, those smaller companies only have an average P ratio around a 16, meaning they would need to increase 39% in price just to match the S&P 500. And personally, my opinion on this is that's not going to change. The bigger companies keep attracting more and more of those passive dollars, and due to their own success, this is just getting even worse. Back in the day, like we just said, they only received 7.5% of all that passive money. Now those companies, just 7 in the market, receive 30% of all passive flows. Not only does the absolute dollar number of money flowing into those big companies, that's really impressive, 9 trillion over the last decade, but they have a multiplier effect. More and more people want to invest in winning companies, as discussed by this professional finance guru here on this podcast.
When I do the math between those two, typically if you're giving money or taking money away from an active manager, the multiplier is about 2. So you give me $1, I go buy some stocks. The impact on the aggregate market cap is roughly a $2 increase in the market. If you give it to a passive fund at this point, my numbers are saying somewhere between $17 and $20 worth of multiplier.
Winning in the stock market has just become extremely difficult. For example, you might have invested in Apple stock about a decade ago. When I first started looking at investing in stocks, Apple stock was only around a P ratio of a 12. Well, they have over doubled that valuation. At the moment, Apple has around a forward P ratio of about 28. So over a double compared to when I first started looking at stocks. However, even just in the last 5 years, the valuation has skyrocketed so much because once again, Apple attracts a lot of passive flows, but the true performance of the company does not deserve that valuation. Apple over the last 5 years has barely grown true revenue growth and true profits, maybe up 5% per year on average. However, the company is up 120% in stock price. If anything, Apple deserves a P ratio, maybe around an 18, not a 28. Another large company in a non-tech sector that has also benefited from passive investing is something like McDonald's stock. Because of its big size, it's in the top 50 by size of companies in America, McDonald's over the years has mainly increased profits through increasing their revenue through the ceiling. For example, charging 200% higher prices for McChickens. That's an absolute travesty. People should go to jail for that. Even with all of those price hikes, McDonald's is only making 35% more operating profit. Think about what McDonald's stock has done in price performance for the stock. McDonald's is up 220% over that same decade time period. Many people are making the case that these large cap companies have just far exceeded their fundamentals. Their valuations are too high for the growth that they are seeing in their profits, in their revenue. And one of the biggest reasons is due to these passive flows. And the question really becomes, when does passive investing all of a sudden turn into passive selling? This idea is called cash flow. We can just apply the cash flow definition for money coming in and out of investing in the stock market. So at the moment, I would say we have positive cash flows through investing in stocks. There is more dollars going into the stock market passively than people taking money out of the stock market. That would be negative cash flow. I would make an argument here that McDonald's stock, their true valuation is something like a 20p ratio. They're currently at a 26. They should drop about 30% in value just to meet the true fundamentals. But that's for a neutral situation. If we had negative cash flows, if money was taken out of the stock market every single year, for example, helping people pay for their retirement, then the P ratio of McDonald's should be something closer to a 16, for example. So that would be more like a 40% drop in McDonald's stock. Now, that might sound impossible during these times, but think about every single bubble in the stock market. In 2000, people believed stocks couldn't drop because of the new tech era. There was all of this technology and growth in profits. You could never see stocks collapse. Even in the 1929 stock bubble, nobody believed that stocks could go down because there was a record amount of people entering their money into the stock market. Everyone all of a sudden put their spare change in investing in 1929, created a bubble, and then all of a sudden, when the money flows became negative, people started drawing out their money out of the stock market on average. That's when you see the collapse. I've got two different factors explaining why we could see that cash flow principle with passive investing turn negative. But I just want to quickly just summarize my thoughts here. I'm not saying we should all just sell out our companies out of the market. You can even see with my growth on sale portfolio, I'm trying to express my ideas with very clear investments here. I've gone for a couple traditional names like investing in Google. They are a undervalued growing tech company. But like I said at the start of the video, I've got PG&E Utility in California, a super cheap utility company on sale. I'm just trying to avoid overhyped, overvalued growth companies. In summary, we're not being scared. We don't have a loser's mentality. We still need to make money investing to survive in this affordability crisis. But we also want to play things smartly. But getting into those factors about where negative passive investing could come from, we need to address the idea of the current age profile of Americans. So for example, maybe back 30 years ago, there was just so many young people entering the workforce, paying into the tax system, but also saving a bit of money and investing in the stock market. However, I believe there has been a fundamental change that's slowly been happening since 1999 actually. This is looking at the percent growth in the proportion of working Americans out of the total population. This is looking at the percent increase in that ratio from 1960. And what it seems like, we had a huge spike during the 70s, 80s, 90s, mainly as females entered the workforce. It seems really difficult for us to increase the percent of working people out of the total. We keep hitting this cap that we formed in 1999. We've got as many young people in there as possible. We've got females in there as well. We've got the older population slowly reaching retirement. A huge amount of baby boomers in their 60s going to their 70s finally retiring. Repeating why this is so important, if you have more and more people retiring, they do not have more money coming in to invest. If anything, they've got the same amount of money in the market and they're going to slowly draw on those retirement funds, withdraw from the stock market. That's only one factor though. If we also consider who has more money at the moment in the economy, but I would say at the moment, 100% certain older people have more money. That is just no argument at all. For example, every single person you've ever met under 40 has complained about the affordability crisis. And for good reason. Young people just don't have much spare money laying around. And quickly showing some evidence for this, we have the personal savings rate. So this is for working people, how much money they have left over once they've paid for essential costs. At the moment, we only have a savings rate of 5%, whereas back, 30, 40 years ago, people were saving around 10%. I'm posing an argument here, purely my opinion, that younger people are slowly going to become less and less of the population, but they're also getting squeezed so strongly by this inflation, by the affordability crisis, that even their paychecks, the amount they can put into the stock market is less and less. Out of all the people I know, how many actually put money into the stock market? I pretty much love this stuff. I think about it all the time. There's me, my brother's pretty into it as well, but there's not many others that like to invest spare money. They're spending it on weddings and holidays, all that stuff. The money being invested by young people is nowhere near going to overcome the burden of old people withdrawing from the system. They need to pay for their retirement somehow. We're going to land the plane here for the final part of the video, and I'm just going to give my thoughts about what this passive investing negative flow is going to do to the broad stock market. I'm going to keep coming back to that McDonald's example. We have had such a strong positive flow passively, pushing up the valuations of those large cap companies that yes, McDonald's is about 30% overvalued. However, if we go back to neutral cash flows for the market, so people putting in money is the same as money coming out, then we're going to normalize valuations. McDonald's will go down 30%. But what happens when we have negative cash flow? People withdrawing strongly from the market, that's going to send valuations below the long-term average. Your McDonald's stock might go down to a 16, again, resembling about a 40 to 45% drop from today's prices. And that does not even include big growth tech companies, really overvalued, lots of excitement right now. If we get anywhere near a recession, that cash flow might turn negative, people get scared, and we have the names like Palantir, just picking on another overhyped company. They have a trailing P ratio of 586. If we go through recession, Palantir might go down something like 80%. So giving my 2 cents here, I'm just staying away from way overvalued companies. I might be playing some risk here, picking these utility companies, these paper towel companies with a lower valuation. But if we do go into a recession or the market starts to collapse, I might lose 10% of my money rather than losing 80%.